Hello and welcome to the Fortune Knowledge Group. I'm your host, Adam Johnson. Recently, KPMG released its M&A market survey for 2016 Insight from M&A executives on what's driving competition, valuation, and record transaction volume. Three senior KPMG professionals join us to share their expertise. U.S. strategy leader Alex Miller focuses on transformational deals and corporate restructuring. Chad Seiler leads KPMG's technology M&A practice in Silicon Valley, and Keats Aiken heads financial due diligence for the firm's power and utility clients. Gentlemen, thank you for sharing your perspective. Alex, I want to start with you. As the person sort of overseeing the big picture, we've witnessed 2 years of record M&A activity. Are we going to see a third of the drivers in place?
Well, certainly there are many growth drivers in place. CEOs are looking for new avenues for growth. With economies in the US, China, and Europe slowing, CEOs need to be more and more creative about the sources and the types of acquisitions that they pursue to achieve that growth.
Right, and of course CEOs hire your company to try to figure out what they should be doing. Keats, as you sit down with CEOs, what are they telling you about their priorities?
Definitely growth, finding expansion opportunities, and being disciplined and smart about how they're approaching the marketplace. I think those would be the highlights. I think there's definitely concern when you look more broadly. Equity prices have fallen, the debt markets are uneven at best, and the outlook, although still positive, is much more questionable today than it was a year ago.
Yeah, right. 69% of the respondents, of which there were, by the way, about 550 executives surveyed, 69% they thought valuations were unsustainably high as of last year. Now we're into 2016, markets have started to trade down. So shouldn't that help business?
It definitely will. And when valuations come down, usually right in turn with that is multiples. So as we see valuations fall, we'll see those multiples fall. Unfortunately, though, that will potentially coincide with the debt markets not being as ready and available. So it will pose challenges to some of our private equity clients as they look to execute deals. It will also pose challenges to our corporate clients when they use stock as currency. Thankfully, they're sitting on record cash on balance sheet, which gives them greater flexibility.
Yeah, about $4.2 trillion amongst the S&P 500. That is a record. Chad, you're our West Coast guy. It's nice and warm out there. I'm curious, it's also hot for deal activity. 70% of the executives said they see more deal activity in technology. 70% was the highest. You focus on tech. What areas within tech?
I think it's the traditional areas we've seen over the last 1 or 2 years around cloud and cloud enabling technology, everything going digital, becoming a digital business. The requirements of security, digital security, with the requirement in today's world, it's not really discretionary on the part of companies. So there's a lot of innovation around technology and hence a lot of M&A transactions in that space. I think we're going to continue to see consolidation in the semiconductor space, which we've seen a significant degree of in 2015. And various areas like that are the core fundamental drivers and secular things happening in the industry that we believe will drive growth in 2016.
I feel like we've all become kind of data hogs, right? I mean, data drives everything, doesn't it? I mean, as you're looking at deals, is that your starting point?
It definitely is a key component. I don't know if it's always the starting point, but as we look at how competitive, not only how competitive M&A has become, but how condensed the processes are, and the fact that the sellers oftentimes come better prepared to processes. On the buy side, our clients have to differentiate, and they have to have insights that others in the bidding process do not, and data is right front in the center of that. So without a doubt, it's increasingly becoming a component of deals.
And Alex, describe the due diligence process.
The first step is strategic fit. Strategic fit is absolutely the most important criteria that our clients need to get right. 67% of our survey respondents identified strategic fit as their most important criteria, and in our minds, they're dead on. Ultimately, companies need a clear plan for creating value in the companies they acquire, and that plan starts with fit.
That doesn't say much for the private equity side of business. That's cash flow, right?
It is cash flow, and it used to be cash flow, but more than ever now, private equity firms are really positioning themselves to be right alongside strategic buyers in their knowledge of the sectors that they target. So gone are the days that strategic buyers used to be in advantaged positions to evaluate companies. Private equity firms have gotten very effective through focus, through their use of advisors, and getting just as smart as the strategics. And in some cases, they're smarter and able to move faster.
Yeah, well, they're the Wall Street guys, or the supposedly the smartest ones in the room, right?
And they're not all Wall Street guys. Private equity now is filled with operators. They're filled with investors who have been sector focused for a long period of time. And with that focus and track record comes a lot of knowledge.
So is it fair? And by the way, all you guys, I want you to weigh in. Is there a difference between how private equity firms approach a deal versus strategic buyers?
From my perspective, it's not about strategic or private equity any longer. It's about smart money. And the idea of smart money means a buyer that has a clear thesis for targeting a company and a clear plan for creating value in that company. As Keach mentioned, whichever of our clients can establish a privileged knowledge position with a target, they can have better knowledge, they have better insights on how to create value. Those are the best buyers for an asset.
Is it fair for me to say, Keats, that's your specialty? It's the due diligence, it's running the numbers beforehand to find that one bullet point that says that's why we do this deal?
To a degree, but we would say it's much more than running the numbers. I mean, when you look at really disciplined, highly effective acquirers, they're looking for a diverse perspective, and it's a lot more than just how the numbers pencil out. So oftentimes, to Alex's point, thinking up front, what is that investment thesis? Testing that investment thesis, not only numerically, but going through with a different lens as to how you evaluate all the different components of the investment thesis. So it's bringing to bear research, it's bringing to bear benchmarking, it's bringing to bear a better understanding of what's really driving the profitability in these companies. And then ultimately, what is your plan post-close to enhance all that? So to really do that properly, you need a broader perspective and you need a bigger team.
How do you, I understand how you can do a pro forma balance sheet, a pro forma income statement, fine, that's numbers. But how do you actually test a thesis for something that hasn't happened yet? Like physically, for an operating business?
You have a long history in many cases, and you can go back, there's various business models out there, but you can really look at the unit economics of a company. You can look forward many years, look at those in-market, growth dynamics, trying to link the two and get a real perspective on how a company is going to grow. How is it going to grow organically? How is it going to grow inorganically? What are the individual components of that? How do we test and validate those, and in some cases refute those? And again, it's more than just the numbers, because you need that that broad industry perspective, and you need a really mix of skill sets to drill into it numerically and operationally.
You were going to say something?
That's probably how our business has changed the most in the last decade. It was principally a business that focused on financial issues around accounting, issues around risk, issues around taxation. Increasingly, our clients want to know, how does the target make money, and how can they expect to continue to make money with the target going forward? And what are the key factors that contribute to that, whether they be commercial, whether they be operational, whether they be organizational. The notions of simply relying on financial analysis are way in the past. Today, our clients want us to combine financial knowledge with operational knowledge and commercial knowledge to really give them a very complete picture.
And I would probably take it a step further, and I'd go back a decade ago. Diligence was a defensive step. It's increasingly becoming an offensive weapon in a very competitive.
In other words, it used to just be, I want to make sure I don't get caught. I'm going to do my due diligence. But now you're actually using the insight to push forward.
Correct. You're really using that insight to truly understand what you're buying, and then to have an investment thesis to how you're going to enhance it.
Yeah, we've also seen it migrate from how do I pay less for an asset because I've identified issues and risks. That pendulum shifted, particularly in 2015 when valuations were high, but competitiveness for an asset was very high, to help me identify KPMG the opportunities in the asset where I can actually pay more than others at the table and win the bid.
How do you, focusing on technology, approach a company that is not yet profitable and yet offers value?
Yeah, that's where the forward-looking aspect of our work really comes to light. That's where, looking in a rearview mirror, what's happened in the business has zero meaning in a startup situation. Right now, we're looking very forward on, what is the real viability of the technology? Do we really understand the customer base? Do we really understand the market beyond that customer base, and bringing in our strategy capabilities that Alex leads to really help us think more holistically about the market, about pricing, where this business is going to be going over the long haul.
Alex, how important is speed in getting deals done?
It's absolutely critical. Most private equity professionals would argue that you can tell if an investment's going to be successful in the first 100 days post-closing. Having a really concrete plan for how you intend to operate the business, what are the key strategies, what are the key opportunities to immediately make impact, those are key elements of that work. And that work starts before you close. That's got to be a core component of your initial due diligence, is really understanding, what do I want to do with this business once I own it? And do I have a better idea of what I want to do with it than the others that I'm competing for?
What typically is the time, and Keith's way in here, from the time a client will hire you, say, we'd like to explore some alternatives, and all of a sudden there are tangible possibilities on the table, and then something actually goes public?
Sometimes it's as short as, 3 weeks or a month. Other times it can ideally be as long as a year plus. Our more sophisticated buyers are spending a lot of time understanding the markets in which they're investing, and that requires a lot of upfront work on research, and in many cases benchmarking, forming a thesis, really canvassing the market, evaluating targets, and finding those right opportunities, and when the opportunities do come, executing.
Chad, there are something like 161 unicorns now, right? Private companies worth more than $1 billion, most of them obviously technology, most of them in your neck of the woods, Silicon Valley. Why aren't they coming public? Why aren't they getting bought by other people? What's the holdup?
Yeah, I think valuations started coming off pretty significantly back in late 2015. I think the high altitude valuations of technology overall, and in particular around the unicorns is coming off. We're seeing a significant volatility in the public markets, some really significant repricing of public equity, which is now working its way into the private markets. And I think we know certainly what we're seeing literally live today. There's valuations that were significantly higher going in, our clients had into a particular transaction. We're seeing those come off pretty rapidly, and a lot of deals being walked away from still on valuations, but I think that's going to start coming off pretty quickly as we move into 2016.
Yeah, interesting, because only 31% of the people in the survey said that valuation was an issue. So maybe it's more of an issue than they thought, is what you're saying.
I think it is an issue. I mean, I spoke to some clients this week who look at the valuations coming off in 2016 as a significant opportunity. So even though we see a lot of headwinds in the market on a macro level, I think 2016 is going to pose some really significant supply side opportunities, particularly in private equity, where valuations have come back down to reasonable levels.
And what are those opportunities?
I think we're going to see a lot more carve-outs from large-scale public companies that are looking to continue to look at the portfolio, divest non-core assets with at lower valuation levels are going to represent some significant buying opportunities in PE.
In other words, you want to sell a non-core asset, you get a better multiple for it, focus on your own business, and you get rewarded because you're clean and easy to understand. Is that it?
Yes.
Understood.
And activists are encouraging corporate leaders to really take a hard look at their portfolio of businesses, really understand what fits and what doesn't fit, and really take a hard look at whether they should continue to own the business that they operate. They're not sitting around and letting management teams figure this out. In situations where they feel that the corporation is being mismanaged, they are stepping in aggressively and they're forcing change.
All right, I want to go around with all three of you. Very simple concept. You are talking to some of the most successful, focused CEOs in the country. These are your clients. I want to know what they are telling you about M&A specifically for 2016.
Driver of growth. I mean, they're half a decade now into some very, very anemic growth in our U.S. environment. We've got the headwinds of the dollar. We've got the macro situation going around the world. We saw Janet Yellen speaking earlier this week about the continued sort of volatility and challenges in the broader marketplace. And I think the need for growth remains, and that is going to be the core driver for M&A in 2016. That's going to be supported by low interest rates and significant amount of cash on balance sheets and in the coffers of private equity.
Markets are changing. We're seeing consumers and their behaviors change. We're seeing their preferences change. This is having a significant disruptive impact in many of our clients in all industries. Some of the examples like Uber and Airbnb and their disruption in their sectors is obvious. But there are many less obvious examples. Think about sleepy industries like the paint industry. Who would have thought that industry could be disrupted by technology? But you have startups like PaintScent, businesses that are changing the way that consumers select paint and hire contractors to actually do the work. That's being felt in all the sectors where our clients operate, and that need to change and position yourself for the future is really a key CEO priority.
So are we going to see old line companies that have been around for a long time, 3M, Corning, et cetera, go out and buy the edgy new companies, the startups who are doing something different?
I'm not sure if they're going to buy those companies. I'm not sure if they're going to partner those companies. We're seeing examples of each. You don't actually need to own a business to understand how it's disrupting you or how you can respond to that disruption. Sometimes a partnership will work, sometimes a simple investment will work. But our clients are very interested in evaluating those options because they've looked at the way that those companies have disrupted other sectors and realized that if they're not careful, that same disruption could face them.
Let's talk about different sectors. Energy, ripe for consolidation?
I think we definitely will on the upstream side. If you look at, just traditionally in the M&A space, energy is represented about, a fifth, in some cases a little bit less of the value of deals, less so on the volume. In the last 18 months, that's extremely depressed. We're now seeing a situation where companies in the energy sector are capitulating. They are being faced with the reality of energy prices. In many cases, their hedges are rolling off. And in the year ahead, we will see many distressed situations. And we will see some core valuable assets that are finally coming to the market. You combine that with the fact on the private equity side, there's been record fundraising in energy funds. There's a significant amount
and it's almost like a vulture fund, right? Like swooping in to buy distressed assets.
I would say it's a disciplined fund, and it's a very smart strategy. There's a lot of money that's been raised in the sector that's patiently waiting for the right opportunities at the right valuation. So it is not without risk. It is risk adjusted, the returns that they will ultimately earn. But they will have many, many opportunities that are very unique in nature in the months ahead.
You talk about risk-adjusted returns. High-yield bond spreads have moved out to a point, 750, 800 basis points. They're discounting 6% defaults, which is historically very high. Chad, what are technology companies having to do to get more creative in order to get these deals done where the financing might be a little bit trickier?
On the private equity side, I think we actually see some deals fall apart in the last 2 months, where some of the most strongest private equity brands we've seen in the technology space actually failed to get a deal done because of financing.
And how long had it been since that happened?
I hadn't seen it in years, personally. But I think beyond that, that's why a lot of our clients are having us focus very, very deeply on the recurring revenue and cash flow basis of these businesses, to get really deep into the numbers, to use data and analytics capabilities that KPMG has developed to really understand what's fundamentally happening in the business, what they can bank on, where they can really cut costs in the R&D side, increase pricing, potentially even fire customers to get a better overall pricing model, to make sure that they really understand the fundamentals of the business and can bank on it.
What are you seeing, Alex, on the give back?
One of the things we're definitely seeing is that private equity firms and corporate acquirers are having to be more creative in the way that they evaluate targets and the way that they find value in those targets. Gone are the periods where you assume that the economy was going to be at your back and that operations would continue the way that they had over the recent periods. Now our clients are looking harder at how are they going to operationalize change in their companies, how are they really going to get their hands into the company to create more optionality, to create value. You can't rely on the market to back you. You can't rely on the economy to drive growth and the creation of value in the companies you buy. You really have to do it the old-fashioned way, which is going in, making change, doing restructuring, buying assets that may be a difficult carve-out and standing them up and taking them to market as a standalone business, and doing the hard work of building value in companies.
I want to talk about geography. One of the biggest numbers in the survey, 79% of those surveyed thought that deals would be done more in the U.S. than anywhere else. What is it about the U.S. market that attracts the buyers and the sellers, for that matter, as opposed to cheap valuations in emerging markets or picking up the pieces in Europe? What is it about the U.S.?
Stability would probably be the thing. As volatile as the equity markets are, as uneven as our debt markets are, our economy, relatively speaking, is much more stable.
Even if it's only 2% growth.
Even if it's only 2% growth. And that 2% growth is not necessarily a bad thing. That's still great growth, given how large our economy is. The other thing we'd probably quickly cite is when you look at that percentage in comparison to the overall volume of U.S. deals, in comparison to the worldwide deal activity, it's not that far off. You know, the U.S. has always led in deal count and deal value. You combine that with the global trends that are going on, and it's not surprising that the survey results are what they are.
Yeah, I think in technology, it's just the quality of the assets.
Right.
There's a significant degree of quality in terms of technology in the U.S. relative to other parts of the world. Yet we continue to see upticks in Western Europe and Israel. We also have a lot of large U.S. corporates with a lot of overseas cash. So, you know, doing a transaction overseas using that cash is almost a way of getting a deal done at a discount.
And our legal and regulatory environment allows buyers to make changes in the companies they acquire. Our clients have less flexibility in other geographies where regulation may reduce their ability to make changes to the businesses that they buy. And in periods of difficult or uncertain economic conditions, if you don't have the flexibility to make changes, it certainly tempers your enthusiasm to pursue something.
How, on a scale of call it 1 to 10, how regulated is the U.S. versus other major areas of deal activity? Europe, emerging markets, et cetera, China?
I would say that there are a number of factors that I feel like dovetail with this concept of regulation. One of them is this notion of stability or the rule of law and the stability around law and the protections afforded by law. In terms of regulation, I would say that most sections of the United States are very moderately regulated compared to areas like Europe. Maybe a 4 or a 5 versus most of Central Europe would be an 8 or a 9. I think Asia has in South American countries have qualities that are more similar to the U.S. in terms of their overall levels of regulation, but they have other legal and structural issues that make them higher risk in terms of completing transactions.
All right, a couple of key themes for 2016. I want one from each of you. Keats.
I would say the combination of better prepared sellers and more disciplined buyers. And when you combine the two, what you're really faced with is deal speed and the ability to execute at deal speed. And by better prepared buyers, what we mean is people that not only are coming into a process being more prepared to move quickly, but have a real strategy to make that process more competitive, keep more bidders in that process longer, and reducing the barriers that have typically caused them to drop, to really have true competition on the final bid. Conversely, on the buy side, responding to that and needing to be smart. I think all of our clients know that the diligence needs to be holistic, that the diligence needs to be very forward-looking, that it needs to be about value creation. The challenge is doing that at deal speed. Everyone has the aspirations. Having the execution ability behind that is difficult, and I think we'll see both on the sell side and the buy side improvement in those areas.
Yeah, and I think beyond deal speed itself, which is all around execution, I think it's how do we get more business intelligence out of the work we're doing around the deal and turn that business intelligence into actionable plans to drive value creation on a post-deal basis. So instead of just doing the traditional work that you typically see in a deal context around diligence and planning around the deal docs and executing the actual transaction, which is a signature on a piece of paper, our emphasis is really now around how do we drive all the insights and intelligence we got out of our work and collectively across the group of advisors for our client and drive that into 100-day plans and other actionable actions that help us drive that value creation and execute more quickly post-deal to prevent value erosion and drive more enhanced value creation.
Our most successful clients are focused on agility. They're looking at these challenging economic and market conditions, and they're responding by making changes to their businesses to reduce complexity so they can respond to market opportunity more quickly, so that they can change in a repeated manner in response to changes in markets and changes in opportunities. In many cases, they're taking that outside-in activism view and taking it from the inside out. They're really looking to make the right changes to their business model to ultimately position themselves for the next wave of growth.
Gentlemen, that is all the time we have. You've certainly given us a lot to think about for 2016. And our thanks to all of you. Be sure to check back with us here at the Fortune Knowledge Group.